Hello everybody, welcome to Monday Morning Must Knows. My name is Merlin Rothfeld. Right now is the time for you to take your neck braces off from all that crazy volatility over the past week. Sit down, grab yourself a nice frosty beverage, and let's find out 3 important things for the upcoming trading week. Now we're going to start stuff off with the normal. We're going to go through earnings calendars. Yes, I know, kind of boring, but there are a couple big names reporting this week. We'll start things off on Monday with Sienna, and that's one of 543 companies reporting this week, a lot less than last week. Tuesday brings you Casey's General Store, again a small one. Wednesday is really the bigger day. You've got Oracle, Campbell's Soup, and Franco-Nevada, a silver royalties company. Thursday brings you JD.com, Ulta Beauty, and DocuSign, and Friday brings the Buckle. So a little bit of a snooze fest there, but trust me, it's going to get a lot better. Now we're going to move into some central bank pieces here because the ECB has their main refinance rate coming out on Thursday. Now that announcement is supposed to be at 7:45 a.m. and they're expecting it to stay at 0%. Now why is this important? Well, let's go back and look for the past 20 years on what the ECB has done. I know, you're thinking 20 years, they haven't been around that long. Well, going all the way back into 2003, you can see that the rates were fluctuating wildly, going all the way up to over 4% back in 2008. But then, financial crisis hits, they chop significantly, and then right around 2015, they peg it to almost zero. It actually is zero right now, and it's been stuck there ever since. Now, the reason I bring this chart up is because if you look at almost every other country around the world, they're all talking about raising rates. We've got inflation. We have some problems in our economy. Let's raise our Fed funds rate or central bank rates to help slow down that inflation crunch that most are feeling. You look at that chart, they're basically pegged at zero, which means they're keeping their pedal on that gas pedal, which could further exacerbate inflation problems for the European Union. So at this meeting that's happening on Thursday, I don't expect there to be a rate increase, but I do expect the talk track to change a little bit towards, you know what, maybe we need to come off that 0% and go to 25 basis points or 0.1 basis points, and that could change the trajectory of the Euro and European countries' stock exchanges. Now, the big stuff, the one that I'm really excited about, and of course I was referencing your neck brace from all this crazy volatility, that is market volatility. We've seen some amazing moves, and with this comes a huge cautionary note from us at Online Trading Academy, and that is risk management. When markets go haywire, quite often you can see the futures exchanges or banks raise their margin requirements, meaning they're going to require you to put in more money to fund your positions. So you may find yourself in a position right now in, I don't know, gold, wheat, soybeans, corn, S&P 500, whatever that market might be in the futures, and they're going to say, you know what, it was $3,000 of margin requirement, but because of this volatility and risk to us, the exchange, we're going to now raise that to $5,000. And all of a sudden, you might find yourself in a margin call situation. Now, how does this relate to the overall markets? Well, let's take a look at some commodities here and some futures products to see what that really means. We'll start things off with gold. You can see that gold, obviously, over the past month and a half has had an amazing run. Well, down at the bottom, I've put on average true range, which tells you how much this security is moving on a daily basis on average. There in that red box, I'm highlighting specifically where that red box starts to where that little blue line ends on the right-hand side of your chart. That's a 68% increase in gold in just about a month. Now, what about crude oil? We've heard so much about crude oil. Well, if we go back to the end of January to where we are as of Friday, we've moved up over 118% with regards to average true range. That means we have more than doubled the volatility of that security. Next, wheat. We know Russia exports a lot of wheat, and this one's going absolutely haywire. Lock limit up almost every single day now. That ATR, just in the past 2 weeks, is up 86%. You're like, well, I don't trade these commodities, Merlin. I just stick with indexes. Well, let's look at the S&P. Going all the way back into November through where we finished on Friday, the S&P 500 has increased its volatility by 178%. Now, because these numbers are so large, that tells you the exchanges are now in a much riskier situation because the fluctuations can be so wild. And to put it even deeper perspective, let's bring this chart up full screen again so I can give you some good numbers. If you look at this S&P 500 and see where it's spiked up and peaked, its all-time high is at 4,800 back in December of 2021. That daily ATR back then was roughly 58 points per day. Remember, 58 points per day, and it was a $4,800 security. Now, on the hard red edge, it's 4,300 and the ATR is double. So it's even more amplified because back in December of 2021, 58 points per day on a $4,800 security was maybe a lot. but now you have double the volatility and that security is even cheaper, which just amplifies the volatility. So the cautionary note is this: risk management. Now might be the time to scale back your trades, the volume, the amount that you're trading. Scale it back a little bit. We don't know what's going to happen in Ukraine. We don't know what's going on with Russia. It's just a wild unknown, and the exchanges are a little bit scared. They may start to raise your margin requirements for the assets that you're trading next week, and that could imply some risk. So be careful. We'll see you next week on Monday Morning Must Knows.